Have you ever felt a surge of certainty about a stock, a market trend, or even your own investment prowess? A feeling that you, and you alone, possess the insight to outmaneuver the market? If so, you're not alone. This sense of knowing, this conviction in our abilities, is the very foundation of a hidden enemy in your investment journey. We all want to believe we're in control, that our choices, our analysis, our strategies are what truly dictate our financial destiny. But what if I told you that this feeling, this illusion of control, is actively sabotaging your portfolio? Today, we're going to uncover a pervasive behavioral bias, one that's far more insidious than fear or greed. It's a bias that whispers in your ear, convincing you that you're smarter than you are. It's called overconfidence, and it's fueled by the illusion of control. Think of it like this: you're standing at the edge of a vast ocean, believing you can control the tides. You can't. The market, like the ocean, is governed by forces far greater than any single individual. This isn't about shaming you, it's about understanding why you might be making costly mistakes. We're going to dissect the core problem, the devastating impact of overconfidence, and most importantly, the path forward. We'll look at data, we'll examine real-world examples, and we'll learn how to reclaim control of your investment decisions. Our goal isn't just to understand this bias, but to transform you from a reactive, emotionally driven investor into a disciplined, data-informed strategist. Are you ready to challenge the consensus and find your edge? Let's dive deeper into the heart of this illusion. Overconfidence isn't just a feeling, it's a deeply ingrained cognitive bias rooted in how our brains process information. Our minds are wired to seek patterns, to find order in chaos. This need for predictability can lead us to overestimate our abilities and underestimate the role of chance. We see a few successful trades and suddenly believe we're market gurus. This is where the Dunning-Kruger effect comes in. It's a cruel irony. Those with the least expertise often display the most confidence. They don't know what they don't know, leading to disastrous investment choices. Data consistently shows that individual investors, fueled by overconfidence, often underperform the market. Even seasoned investors are susceptible. Market analysts, supposed experts, frequently make predictions that fail. The allure of being right, of predicting the next big move, can cloud judgment. Consider the countless investors who chase hot stocks, convinced they've found the next Apple or Amazon, or those who ignore diversification, putting all their eggs in one basket, only to watch their portfolios crumble. The emotional toll of overconfidence is immense. The pain of losses is amplified when we believe we could have prevented them. Admitting mistakes becomes a Herculean task. It chips away at our self-esteem and fuels further poor decisions. But understanding these psychological mechanisms is the first step toward breaking free. It's the key to dismantling the illusion and building a more rational, resilient approach to investing. Always remember that the market doesn't care about your feelings. How do you know if overconfidence is secretly sabotaging your portfolio? Let's uncover the red flags. Knowing these signs is the first step towards reclaiming control. One of the most glaring indicators is excessive trading. Studies consistently show a direct correlation between high portfolio turnover and underperformance. The more you trade, the more likely you are to lose. Concentrated positions are another warning sign. Do you have a few stocks that make up a large percentage of your portfolio? Are you convinced you know more than the market about those companies? This is the hallmark of overconfidence. Overconfident investors often ignore negative information. They selectively process data, dismissing anything that contradicts their existing beliefs. It's a form of self-deception, a refusal to acknowledge potential risks. Chasing past performance is another telltale sign. Buying high and selling low is a classic symptom of overconfidence. The belief you can time the market is a dangerous delusion. And finally, failing to diversify. Do you believe your stock picks are superior to a well-diversified portfolio? Are you convinced you can pick winners better than anyone else? This is a recipe for disaster. These red flags aren't just theoretical concepts. They are real-world behaviors that can devastate your returns. The good news is that by recognizing these patterns, you can begin to change your behavior. You can start to build a portfolio that is resilient, not reckless. Remember, it's not about being right. It's about managing risk. Let's put a number on this. Let's quantify the cost of overconfidence, because understanding the financial impact is crucial to change. Think of the trading tax. Every time you buy or sell a stock, you pay a price. Brokerage fees, bid-ask spreads, and capital gains taxes all eat into your returns. Excessive trading amplifies these costs, turning small losses into significant ones. Overconfident investors often miss out on the benefits of diversification. They put too many eggs in one basket, increasing volatility and lowering returns. A diversified portfolio acts as a buffer, protecting you from the inevitable ups and downs of the market. Then there's the expert fee. Many overconfident investors choose actively managed funds, believing that they can beat the market. But these funds come with high fees, and they often underperform. You're paying for a service that's actively working against you. Historical analysis analysis tells a sobering story. Data consistently show that overconfident investors underperform those who adopt a more disciplined approach. The evidence is overwhelming. And finally, consider the opportunity cost. The long-term impact of overconfidence on wealth accumulation is staggering. Disciplined investing, with its focus on compounding interest, can create exponential growth. Emotional trading, on the other hand, can lead to stagnation or even decline. The numbers don't lie. Overconfidence isn't just a psychological issue. It's a financial one. It's a tax on your future. But understanding the cost is the first step toward reclaiming your financial destiny. So, how do we fight back? How do we inoculate ourselves against the poison of overconfidence? The answer lies in embracing humility and building a disciplined process. First, embrace humility. Acknowledge your limitations. Recognize that luck plays a role in investing. As Benjamin Graham, the father of value investing, wisely said, the investor's chief problem, and even his worst enemy, is likely to be himself. Next, build a disciplined process. Develop a clear, data-driven investment strategy with predefined rules and criteria. Write it down. A written investment plan acts as a shield against emotional decision-making. Automate your investments. Utilize tools like dollar-cost averaging and index funds. These tools reduce the temptation to time the market or chase hot stocks. Seek objective feedback. Consult with an independent financial advisor or participate in a peer review group. Challenge your assumptions and get a fresh perspective. Finally, conduct regular portfolio reviews. Consistently rebalance and review your portfolio using data to measure your performance and identify areas for improvement. Don't be afraid to admit when you're wrong. These strategies aren't about becoming perfect investors. They're about becoming more rational, more resilient, and less likely to fall victim to the illusion of control. They are about building a framework for long-term success. Remember, the market doesn't care about your ego. Let's bring it all together. Let's recap what we've learned and chart a course for a brighter financial future. We've identified overconfidence as a pervasive behavioral bias, a hidden enemy that undermines our investment returns. We've explored its psychological roots, recognized its red flags, and quantified its devastating cost. The power of data is undeniable. It's the antidote to emotional decision-making. By embracing a data-driven approach, we can overcome our cognitive biases and make informed choices. The long-term perspective is key. A disciplined approach to investing, free from emotional interference, is the foundation for sustainable wealth accumulation. It's about building a portfolio that can weather any storm. Now, it's time for action. Assess your own investment behaviors. Identify areas where overconfidence may be influencing your decisions. Are you trading too often? Are you ignoring diversification? Are you chasing performance? As Warren Buffett once said, the stock market is a device for transferring money from the impatient to the patient. The journey from an overconfident trader to a wise investor begins with self-awareness, discipline, and a long-term perspective. Are you ready to take control and build the financial future you deserve? We've reached the end of our journey, but the real work begins now. Let's recap. Overconfidence is a pervasive bias, a silent saboteur that leads to underperformance. Recognizing and mitigating this bias requires self-awareness, a disciplined process, and a long-term perspective. The power of independent thinking is your greatest asset. Embrace critical thinking. Rely on data-driven analysis, not emotion or market hype. Challenge the consensus. Find your edge. The path to sustainable wealth is paved with discipline and diversification. It's a journey free from the pitfalls of overconfidence. It's about building a portfolio designed for reality, not fantasy. As Benjamin Graham wisely said, the margin of safety is always dependent on the price paid. It will reach its maximum at a price that is low enough to offer a substantial cushion against adverse developments. So, as you embark on this journey, remember the lessons we've learned. Take control of your financial future by embracing a data-driven, disciplined approach to investing. Continue learning, continue refining your strategies. The market is a teacher, and every experience is a lesson. What will you choose? Will you continue to be a victim of the illusion of control, or will you become a master of your own financial destiny? The choice, as always, is yours.